A rule of thumb in old school investing circles is to structure your portfolio 60-40, meaning 60% equities and 40% bonds or fixed income. The 60-40 rule has been hammered in the media early in 2023 after a record slide in bond prices combined with an equity bear market last year that left many wondering, what am I doing in this mix of assets? Where's the risk reduction in a simultaneous decline of 20 to 40% in both asset types at exactly the same time? Some of us have argued for years that people tend to allocate too much of their money to fixed income without having a genuine short-term need for funds. Bonds are not a great place to be long-term, despite what happened to interest rates after the catastrophe of 2008, the global financial crisis, and then the COVID pandemic. Boosting long-term interest rates from the economic Armageddon level of zero to some more normal relationship with inflation triggered a 40% plunge in long-term government bond prices. Not much of a safety zone. Rasheed and I begin, as we usually do, at the beginning. Where did we get this notion that 60-40 is some kind of catch-all good idea?
60-40 is a really interesting concept, and it's become very popular over the last few months, mainly because it performed horribly, the worst ever. The idea that you should have 60% of your portfolio in equities and 40% in bonds, and generally speaking, we're talking about 60% U.S. equities and 40% U.S. bonds, and those bonds specifically are U.S. treasuries. Nobody knows why we ended up on 60-40. One of the most famous researchers and ex-colleague of mine, Elroy Dimson, who's well known for working on the annual equity prices update. He has no idea where this idea comes from, the 60-40. The biggest expert on modern asset prices doesn't know where 60-40 came from. I think we can assume that we'll never know. Some do believe that it comes from this idea where U.S. pension funds started adding to equities in the 1960s. By the end of the 60s, that they were about 60% equities. But it actually doesn't really work that well because they actually reduced equities in the 1970s to 50, to more of a 50-50 portfolio. So we're not really sure where it came from. I personally think this is just a heuristic. It's just a rule of thumb. And it's basically telling you a story, don't put all your eggs in one basket. We know that for 150 years, U.S. equities have earned 10% per annum on average. But there have been long periods where they haven't. For 20-year periods, we've always had positive U.S. equity returns. For 10-year periods, we have not. For example, 5-year periods less. For 1 year, it's close to 50-50, in fact, up versus down years. But we've had recently, we had the lost decade, right? So we had the 2000s where the NASDAQ was net down and the S&P was basically flat. So down in real terms, i.e. inflation adjusted returns. There's this idea that maybe we shouldn't be just in US equities. Even though they perform well for over 20 years, over 150 years, over 100 years, 50 years, whatever, there should be some idea that we can get maybe potentially a free lunch from including more asset classes because they're not perfectly correlated. And the start, but not the end game of asset allocation is determine how much equities and how much bonds. We're going to start, it's really easy for us here to explain the concepts of asset allocation in 2 dimensions because it's actually a multidimensional problem, right? Because we have other asset classes, some of which are actually much less correlated to stocks than bonds are, i.e. commodities, real estate, hedge funds.
Okay, there's 2 things that can happen. Stocks and bonds can move in the same direction at the same time, meaning the value of your account hasn't been protected by the fact that you're 60-40 if you happen to have a downturn, as happened in 2022. That's, in fact, it was the worst year ever for bonds, if I'm not mistaken, bond price performance. However, your bond portfolio is supposed to be producing income that you can rely upon. You may have it staggered so that you've got maturities coming up on a regular basis, what you call a laddered portfolio. Therefore, you don't care that the prices are going to fluctuate because you're going to get the face value of the bond, some of the bonds at some point in the near future. And thirdly, probably most importantly, you're offsetting a future expectation of a need for cash by having bonds coming due at a certain point. So I can see why there's some balance. You have some bonds and you have maybe mainly equities. I don't see why, and I think you're already making the points, why 60-40 would necessarily be a good idea. I think longer term, I think it's been a really bad idea.
So you've hit on a really, really important point, extremely important point that has enormous implications. What equities? What bonds? What does that even mean? Like I mentioned before, we usually talk about U.S. equities, right? U.S. stocks for the long run. We have a 150-year positive history on them. We've had treasury bonds for a very long time. We understand how they performed historically. But what bonds? What equities, right? So is this emerging? Is this global equities? Is it U.S. equities? Is it emerging market equities? Like I said before, are we talking about treasury bonds? But what treasury bonds? There's a whole maturity of treasury bonds, and there are bond funds as well. What do we actually mean when we say 60-40? And there's several problems with this concept of allocating X to US equities and Y to bonds. And the first is, as you pointed out, it doesn't always work. There's actually been many years where it didn't work. Turns out that bonds and stocks are reasonably correlated, especially recently, right? And the biggest run we've had, last bull market we've had, has been paralleled by an incredible shrinking of the long bond rate.
Which makes complete sense, just to remind people that interest rates and bond prices move in opposite directions. So as you earn less and less by holding a bond, equities obviously become more and more attractive. As bonds go up in price, they become less attractive. They're yielding less and less money, so money will get chased into, and people have read about this before, money being forced into or chased into risk assets, which causes, and we already talked about this in the bubbles period, it causes an inflationary effect on equity prices sometimes, or disinflation if it goes the other way. People go roaring back into bonds because the yields come back up and they feel that they're not getting enough cash return out of their dividends in the stock market. So I just wanted to clarify that if stocks and bonds aren't moving together, in my book or in my experience, that usually means there's something amiss.
That's absolutely right. So in fact, you hit the nail on the head. Stocks and bonds tend to be uncorrelated in bad times. That's what exactly I meant. Right.
Yeah.
So
thanks.
So the equity risk premium. So let's start with that. So let's go back to why we want to be in bonds in the first place. So you're absolutely right that we're tempering the volatility down, right? We're saying if we have 100% stocks, we might have, let's just use 10 years. 10-year period is really easy. Over 10 years, we might make no money. That'd be bad if we're going to retire in 10 years, right? So what we'll do, we'll put some bonds on there. But, in good times, bonds won't rise as much. And this is a conundrum, right? Because what is my time horizon? All of finance, all financial theory thinks in terms of days and years. But a retail investor's time horizon can be all over the place. You could be saving for a house, or you could be saving to your retirement, or you could be saving for nothing and you've got an infinite time horizon for your kids, right? There's no one answer to what is the right time horizon. So institutions, because they got to play to everybody, they have quarterly reporting, right? Oh, we're up this much money. And if they don't do a good job for a year, you might get fired. That doesn't happen to yourself. You can fire yourself. but normally, you have the ability to not mark yourself to market, to look for the long run. If you have a really long period of time and you believe in history and you believe in the US stock market, tempering your equity portfolio by adding bonds is not the best idea. Bonds yield less, and you don't need the volatility tempering. But bonds have their own risks, right? What risks do they have? They have inflation risk, right? So the idea that I own a bond that yields 4%, wow, that's a lot of income for me. But if inflation is 4%, the bond's not yielding me anything. So we buy bonds, generally have a higher yield than inflation. Generally, they do not right now, but they generally do.
If you want to reduce risk in a bond portfolio, you over-diversify it. The trick is to go with the higher-rated bonds, but also not buy very large amounts of them, because you want to do two things. By laddering up, over-laddering, by getting as many interest payments coming in as you possibly can and having bonds coming due all over the place for the next 10 years, you're taking a lot less risk than having a whole bunch of money in the bond portfolio coming due in big blobs at certain points in the future, because you're always going to be the victim of wherever the yield curve happens to be at that particular time, rather than averaging all the way through it. So bond portfolios in general, I don't think are usually treated correctly. They're or thought of correctly. If you're going to buy fixed income, the idea is to get the money back. You're not in there to, you're not in there trading the yield curve as a future retiree, or trading the credit risk market because you're going to trade up from AA to singles or something. You're not in there as an arbitrage trader. You're in there to get your money back. And if you want to do that, buy lots of little bonds and have them maturing all over the place from the top issuers.
In the past 100 years, if you would have gone 60-40 versus a portfolio 100% stocks, you would have made 7 times less money.
That's a lot, by the way, for
in 50 years.
Yeah.
7 times, 700%, right? 600%, I should say. You would have made, over the last 50 years, you would have made 2 times less money. Stocks versus 60-40. So these are big costs to do exactly what? Hopefully capture a lower risk premium, the inflation risk premium, rather than the equity risk premium. The equity risk premium is very high. Historically, has been very high, right? Like I said, we've made 10% a year for the last 150 years on average. And the numbers range from a -1 in the 2000s for over 10 years to plus 14, annualized, by the way. So in the 1950s, the equity portfolio went up 14% per year. That's 3x in 10 years. This is big numbers. And you know how much bonds yielded back then? 1%. Inflation was over 1%. By diversifying away from the equity risk premium over long periods of time, we are swapping that equity risk premium for the inflation risk premium. 60-40 doesn't always work. So if you're believing that it doesn't always moderate your volatility, even on a yearly basis, right? This year they both went down. Doesn't happen that often, but it's happened more than once. And if you're relying on those bonds to do your, for something, you're screwed, right? The long bond, Blackrock long bond ETF is down 41%. It's a huge number, right? Oh, I'll just invest bonds. They're really safe. I need the money next year to pay.
Should have bought a 1-year GIC, but that's okay.
You're down 41%, right? Here's the third part of this puzzle. You are not an institution. We are not institutions. We should be designing our asset allocation strategy for our needs. And those needs may not involve 40% bonds at all. And even if it does, as you pointed out, in what way would we add our bonds? 60-40 is a simple way to explain the whole issue of how to allocate. We're going to allocate to 2 asset classes that have different returns. They're less correlated than one, i.e. one can go down, one can go up, or one can go up a little, one can go up a lot, but they don't generally move lockstep with each other, right? This is keeping all your eggs, not keeping all your eggs in one basket, but having, in this case, 2 baskets. And what do those baskets look like? I often see I actually see most people with the opposite problem. They have 5 or 6 stocks or 8 stocks.
Warren Buffett does.
That's what they like to do. They're like, oh, I'm researching Tesla. Some people have some people's portfolios are 50% Tesla. And they look like geniuses for a while. And it's been apparently it's the biggest wealth destruction ever.
Well,
right? The fall in Tesla. Elon Musk personally has lost more money. Well, not mark to market, obviously. He didn't lose the money. He's marked the market down more than anyone's ever been down ever.
We'll do a podcast on this someday. We'll just go down a list of the top 20 catastrophes in the stock market and see how many are connected to cults of personality.
When you're in the equity markets, what you really want to do is maximize the likelihood you're going to get the winners, because surprisingly, it's not a stock market, it's a market of stocks. And a few stocks drive returns every year, both positively and negatively. So you want to maximize the likelihood you're going to get them. Are you Bill Ackman? Are you Carl Icahn, Nelson Peltz, David Tepper? No, I am not. So I maybe if I was one of those, I would hold, and they do, 5 stocks, 6 stocks, 7 stocks for years. Hugely concentrated positions. Let's avoid that. You want to capture the equity risk premium. You want to capture the equity returns. If you have 5 stocks, your chance of capturing the equity risk premium of the entire market is near 0, actually. That really is a free lunch. You diversify, you get the index, basically, right? And the index has done really well over the history for a long time. And you mentioned credit investing, and you're absolutely right? It's catastrophe to own exposure to 1 or 2 credits. Why would you ever do that? But here's the deal: the credit risk premium is not captured in that 40%. That 40% is
no
US long-dated, 10-year treasuries, basically. Yeah, no credit risk. If you want to have credit risk in your bond
meaning
portfolio,
an increased yield.
and I don't see why to capture the credit, exactly, to capture the credit risk premium, our yield over treasuries, I see no problem with that. But that you do want to diversify, as you pointed out rightly. You can do it yourself, but even if you're owning 10 corporate bonds,
you can't
still not very diversified,
enough,
right?
We're not making short-term recommendations, and we're not telling people what to do with their money on the podcast. However, you cannot emphasize this enough. If no matter how good you think a corporate entity is, this is especially, and even some government entities, no matter how convinced you are, there's nothing can go wrong with this. You're going to put, and you're in it because you bought a bond because you want the money back. You're making a loan to somebody and you want the money back. You're going to need it at such and such a point in the future. You have to split that into small segments and give appropriate amounts to the absolute top issuers.
Those two issues, diversifying your equities, diversifying your credit, and to some extent diversifying your maturity profile, as you talked about, are true free lunches, right? They give you something for nothing. If you own one bond that yields you 1% over treasuries and it goes bankrupt, let's say zero recovery, you lose all your money. If you own 100 bonds and one of them goes bankrupt, you lose almost no money. We call that a free lunch. For the same return, right? You're kind of rolling the dice if you don't diversify. But anyway, the point is that you've got the equity risk premium, you've got the inflation risk premium, you've got the credit risk premium, you've got the liquidity risk premium, you've got all these risk premia there to be harvested. And they're uncorrelated, or historically they've been uncorrelated. So now I want to talk about, so when we talk about 60-40, what we should be thinking about is risks. Okay. I'm getting somewhere. I'm getting somewhere important here, because our 60 is harvesting the equity risk premium. It's diversified enough, the U.S. equity risk premium, and our bond portfolio, whatever that may be, is harvesting the inflation risk premium. That's all it's doing. It's not giving us safety. We saw in 2020 too, right? Didn't give us safety. It did give us lower correlation, but it's a high cost, right? Over 100 years, you made 7 times less money. So that's a high cost. We want to think in terms of that. We want to think in terms of risk premium. Now, we want to bring in the individual, you, me. What do we need the money for? And that's where you came on your laddering, right? So if I know that I have some obligations, so let's say I am retired and I want fixed income, we can buy an annuity, right? We can basically, it's a bunch of individual zero coupon, i.e. we're going to have a bond that matures in 1 year and in 2 years and in 3 years, and there we'll go and we'll cash our bond, we'll get money to live, right? So that we need that money.
Not going to happen.
We put in the equity market, the equity market drops 50%. We don't eat, right? So this is where we start thinking about, well, what is that 40 supposed to look like? Or whatever our bond allocation is. How are we going to have our bond allocation? We have to think about it's custom to what we want.
You use bonds for what you need the money for a future purpose. I can't get in the camp of the alternate investment class with a great big amount of a portfolio. I can't do it. I can definitely use bonds because I need certain amounts of the money at a point. That's just, it makes sense. Even last year, if I owned a bond and the thing, the bond market fell 20%, but I needed that X number of dollars in November, it's there. Even though the bond market's all shot to pieces, that bond came due and I've got the money. So it does serve a purpose even in bad markets, but I think people own too many of them. It's not that difficult to match what you're going to have happen to you in the bond portfolio anyway if interest rates change in something that's going to give you just as much cash on cash, but keep the equity potential for bigger returns in the portfolio. So when you get markets going the other way, you're much better off.
40% of your portfolio, if it's in a bond fund, never forget it's risky. The way you take the risk out is by doing exactly what you said. Either match asset and liability, right? So you want to buy a house in 5 years, or want to retire in 5 years. Make sure you have enough cash when you need it. And you could buy, if you need money in 5 years, buy a 5-year bond, 5-year treasury. You're done. But you're not harvesting risk premium.
You're just being smart.
You're creating a safety net for yourself. Asset allocation isn't about minimizing volatility.
It won't work.
Annual volatility, daily volatility, whatever it is. It's about making sure you have your safety net, or whatever your goals are. When you think about asset allocation decisions, what we've learned from 2022 is that nothing is sacred, right? You can't rely on that diversity for any small period. To the extent that you want to harvest risk premium, you're doing it for the long run, i.e. for 10 years, there was no equity risk premium. For 10 years, you made no money, right? Into the 2000s, from 2000 to 2010. That's not so good. In that case, you should have some other stuff. Should you have had bonds? Maybe. Or maybe you should have had commodities, which are even lower correlated to stocks than bonds are, with a higher historical return. And that's where I'm going with this, is it's all coming together now, right? There's all these different risk premiums.
Yep.
And that's your risky basket, right? That's your long-term risky basket. Do not be taking short-term risks. Long-term risks with your short-term money. That's what the bonds are for. But the bond fund doesn't do that.
There are types of a bond fund I would consider a hedge fund bond fund, which is nothing to do with what we're talking about. They're out there trading on a professional level, extremely complicated systems that involve, shorting and going long against different credit spreads and intercountries and different currencies. And they're doing things that there's just no way I could replicate. And they've got a method, and their vol is very, very low, and they're only out there to make you 4 or 5% a year. They're not home run hitters. They're almost an alternate money market fund that uses a very special technique. That is about the only bond fund I've ever been remotely attracted to. The rest are not bonds. They're bond funds. There's somebody else's version of a portfolio that was established before you arrived with your money. And if the bond fund is repriced, if you get into a bad market with a bond fund, maybe you can explain this better than I can, or say it in a different way, you're going to have a massive price adjustment, and you're still going to own the same bonds. Whatever was in the fund is in the fund, and they're going to have redemptions, meaning they're going to be selling off most of their best holdings in order to handle the redemption on the bond fund. They can be catastrophic places to have money, because you think you're getting one thing and you're getting another. So I still to this day believe that the relationship between price and yield in the bond market is the single largest problem. The lack of understanding of it is the single largest problem facing retail investors.
The idea that we should decide how much bonds we're going to hold and how much equities we're going to hold is not the question. Right. It's how much risky assets we're going to hold.
Thank
you.
And
a bond fund is a risky asset. And then we're going to have some safe assets, which are bonds, but not bond funds generally. They are cash equivalents, U.S. treasuries, maybe even GICs, that sort of thing. The problem with bond funds, other than the fact they are very volatile, because they're harvesting a volatile risk premium, the inflation risk premium, which we saw in 2020, is fees. So TLT, the Blackrock fund, has very low fees. It's a high duration, so long-dated bond fund. It holds long-dated U.S. treasuries. Has 15 basis points in fees. And there's taxes. Don't forget, this is income, right? It's coming in. There's taxes. There's a tax bill to pay when you own bond mutual funds. And then there's inflation. And in the last 10 years, bond funds haven't done so well after taxes and after inflation. They're basically down. But that's for an ETF. Double Line's bond fund. It has almost 1% in costs. Now let's just assume that it's going to yield 4% a year. That's 25% in fees. That's more than a hedge fund manager takes. That hurts, right? That hurts your return by a lot. And you're not guaranteed not guaranteed anything there. It's a bunch of bonds. It could be actively managed. It is actively managed. You don't know what risks they're taking. At least the TLT and the ETF, you know what risks they're taking. Here, you're not really sure.
Bonds is as I've said many times, the tail that wags the dog. If you have firm credit markets, you'll do okay on the equity side. If you have functioning credit markets, you'll do fine. If you have problems there, the stock market can have the odd hiccup. The stock market can have the odd scandal. The stock market can survive a fraud. If it happens over in the bond market, then it almost immediately gets into the system, and you have all kinds of issues. So we've got all kinds of things to talk about. Bonds is a good subject.
60-40 is a meme, basically. It's an idea. It's not an ideal. Each individual investor needs to think about it. It incorporates a number of important issues, right? Like equity risk premium. We want to capture the equity risk premium, and we want some tempering of volatility. So it's a very good basis to start discussions about what an investor's portfolio should look like. But 60-40 isn't low risk. It's historically done okay, but the 40 has been, over the last 10 years, has been particularly bad, right? It's basically the last year's erased most of its gains. There has been a buffering effect over the long term, But over the long term, equities have outperformed bonds. Convincing ourselves that somehow our 60 and 40, the 40 is safe and the 60 is unsafe, is wrong. Because there's all these different risks. And bond funds have risks, as 2020 show. Even if you believe that 60-40 was a great long-term play, which I do not, you still might be wrong for you, because we talked about some of us want a safety net. Some of us need money at certain times. And having your portfolio in too risky assets doesn't give you any certainty of cash. Individual bonds do, bond funds do not.
Much more on the topics of bonds, bond trading, and the cost of investment strategies in upcoming episodes. At The Rotterdam is a conversation about topics related to people's interaction with money. We talk about financial markets history and, importantly, the many things that are connected to our financial systems, issues that we think should be discussed. If you like the show, please follow. Comments and questions are welcome via the links on our website. For information on Dr. Rasheed Saluddin and myself, Jeff Sandler, and links to important references in this episode, please see our social media sites, including the website attherotterdam.com. Thank you for listening.